All right. Now we're live. Welcome back to the Kansas City Market Pulse, where we are bringing you market insights, leadership stories, and the bold moves shaping commercial real estate across the Midwest. I'm super excited about my guest today. We're going to get to Paul very, very quickly here, but want to just showcase our team. We're out in the Kansas City market, moving and shaking, working on all asset classes from land to office, multifamily, flex industrial, retail, you name it. We're working on it, leasing and sales. So reach out to our team so you're maybe be able to connect with us and find your next investment opportunity or help understand what your property or your portfolio might be worth. You know, our whole aim here is to deliver valuable, up-to-date information on the commercial real estate market, right? So that's current listings, it's market trends, which we're going to talk a lot about today, transaction overviews, any expert insights, positioning us as the go-to source for market intel. Very excited about Paul. Paul and I have known, how long have we known each other now, Paul?
It's got to be like going on 3 years, Logan.
Yeah, it's been 3 or 4 years, and it's been awesome being able to not only just engage on LinkedIn and social media, but actually connecting offline. And I've seen your growth over the past 3 to 4 years, and it's been wonderful. But Paul's an experienced real estate professional. He's a capital allocator, and he's the co-host of the Passive Pockets podcast. I have to tell you a story, Paul. So I'm out in Washington, D.C. last week, right? And I'm out there, and I'm talking to this gentleman, and he lives in Charleston, South Carolina, and he's like, your voice just sounds really familiar. And I'm like, yeah, I'm on some podcasts every once in a while. He goes, no, I don't know where I listened to you on something. And so he gets out his phone and shows me he had just watched and listened to our episode on Passive Pockets. So how cool was that? He's like, man, I couldn't believe the insights you and Paul were talking about with the 18.6 year real estate cycle. So just like that, I'm out in Washington, D.C. Somebody from South Carolina is there talking about your show and our conversation. So I thought that was just phenomenal. And as he was driving up to Washington, D.C., he listened to the whole episode. And I got to tell you, man, I think that show was one of the best that we've done. I mean, it was a lot of fun, and I actually go back and listen to it the other night just to kind of refresh my own memory because I was getting ready for the show. But how cool is that?
That is cool. It makes the world seem so small, but you crushed on that episode. You probably don't know this, but I get some analytics reports, and that was, I believe, the most popular podcast episode on the Passive Pocket circuit. So you delivered some major value there, and I've listened to it a couple of times too. And every time I talk to you, I feel like I learned something. So I was excited about today too.
Yeah, most definitely. And Fred Harrison has been kind of in the news here lately. He wrote kind of the original book that popularized that called Boom Bust. And I think it was back in 2005 when he wrote that. But, I just went back and kind of listened to that and then read some stuff from Fred. And yeah, I mean, it's just an interesting time to be in commercial real estate, which is what we're going to talk about today. But let me talk a little bit about your background. So obviously co-host of the Passive Pockets podcast. We'll get into that here in a second, but you've acquired over 200 residential units through equity recycling and joint ventures. And here's what I think is just phenomenal, and I think a lot of listeners will love to hear today, is you've invested in over 40 plus passive real estate deals. And that's multifamily, industrial, mixed use, and private debt across various capital stack positions. So, I mean, that exposure, not only just to active, but also passive investing, it led you to launch the InvestWive Collective, right? Which is a customizable fund designed to help investors diversify beyond the traditional markets. And I'm excited to talk about that today, but I think you bring a really unique position and viewpoint and perspective because you've done the active real estate investing, you've done the passive, you've done equity, you've done debt, and I'm guessing multiple markets, which we're gonna talk about today as well. But man, Paul, I mean, that's just a wealth of experience and knowledge. I know you're a family man as well. So, man, welcome to the Kansas City Commercial Real Estate Market Pulse, man. How are you today?
I'm doing phenomenal, man. I was actually up a little bit later than my normal time last night at a concert. So I've been drinking a little bit more coffee today, but I'm feeling good, and family's doing well. We're hitting the summer months. My kids are in camp. They're out of school. So our schedule, it seems like, changes every day. It's been fluid, but we're having fun with it, and just enjoying every moment. So it's good.
Wonderful. Well, awesome. What concert did you go see last night?
We saw Mumford and Sons at
That's a good one.
the amphitheater up the street from us. There's about 20,000 people. I've known their music for a long time. I wouldn't say I'm a super fan, but my wife likes them a lot. Some of her friends like them a lot. So we went up there. I was impressed. I really enjoyed the show. It was a good concert.
That's awesome, man. Okay. Well, that's a lot of fun. I'm doing some traveling actually tomorrow as well. I'm headed to Nashville, but last week I traveled as well. And I kind of sat down and was like, oh my gosh, my daughter is now 18, 19 months old. And I don't think I've been away from her for like a day ever. And now 2 weeks back to back, I'm away for like 8 days. So I'm just trying to like brace myself. Right. But it was, we have 3 children, 6, 5, and 1.5, but it was just such a nice, refreshing moment to get with my wife and be able to go to dinner and have some lunches and, sleep in a little bit. I mean, I didn't sleep in much, but slept in a little bit and no interruptions. But we were excited to get back on Father's Day. So I'm glad you're doing that. Let's go back to the beginning, man. What first got you into real estate? Obviously, you were in medical sales, medical device sales previously, but like what first got you into real estate and kind of what was that first moment? Bring us back to that.
Sure. Yeah. I mean, I think it's similar to a lot of people that get into this space looking for additional cash flow streams, sort of alternative income away from the W-2. And that was the goal at the time, was to try to sort of have insurance against potentially loss of job, or, if I decided one day that I wanted to leave my W-2 job, I'd have something already kind of built as a side hustle. So real estate seemed like, I guess, the least risky of business ventures that I could take on. You have the underlying collateral, assuming that you use low leverage. Time often heals a lot of wounds in real estate. So if you give yourself multiple exit plans and you hold on to assets, ideally you have an upside scenario, a plan A, plan B, maybe that isn't so sound as A, and then you've got your plan C. So I always got into it, looking at it from those angles and trying to create cash flow, and started to build a portfolio of single family homes, and kind of saw that the scalability was lacking. I did end up hiring out property management after doing it on my own for about 8 or so homes, and then just worked my way up, got into larger assets, was operating, property as project manager, asset manager, using third-party property management, but was getting into some, heavy value add type plays, 40 unit property, 50 unit property, and had some success there. But I noticed that there was a lack of great deals in the marketplace. And as more competition was flooding into the space, it got harder and harder to find deals. I remember back in 2022, there's some macro things that were going on that had me thinking that, maybe the run up was over. Turns out it probably was, but we looked at 150 deals that year and found nothing to invest in. So I had been investing passively as well. And that's kind of the two-pronged approach. Is I feel like I've got an advantage in my marketplace for my specific niche as an operator of multifamily, but there's not going to be that many deals that come along that often. So I need to find more efficient ways, effective ways to deploy my capital. And I found that partnering with the right sponsors in different geographies and different asset classes, and kind of leveraging their expertise and skill set has been a way to not only diversify my portfolio, but to kind of piggyback off of their success as well.
That's very well put. It makes a lot of sense. I like that dual pronged strategy, right? I mean, you can't, with the markets that you're in, I'm in, whoever is listening is in, it is hard to find consistent deal flow that is going to make sense. And so one way to create that deal flow is work with those folks in the different areas so that you can continue to evaluate those opportunities on a regular basis. So I think that's really, really well put. Paul, we've got a lot of questions already coming in. I'm monitoring them. We will get to the questions for sure, but I have selfishly some questions for Paul that we're going to get through first. You've kind of already answered. You've been on both sides of the table with the flips, with the buy, renovate, rent out, refinance, and repeat strategy, and LP and 40 deals, and kind of talked a little bit about how you decided that the passive side was the right fit for you. And we kind of went through that on the deal flow side. But one thing I want to kind of like think about is somebody's here listening and they're like, hey, I own real estate. I'm doing stuff myself actively. What was that aha moment that kind of pushed you from, hey, other than just, hey, the scalability of it, but was there an aha moment where you're like, oh man, I really got to start understanding how to become a limited partner and or partner with sponsors? Can you take us back to that?
I don't know if there was actually a definitive moment. There was a series of moments as you kind of work through all the problems you work through when you're actively involved in real estate. As a manager originally, getting phone calls, at inopportune times, having, a pipe leak or, roof leaking or whatever it might be. I always found that I was dreading when I would get a specific, a tenant calling me about something, because it was never a good thing. There was always a problem to deal with. And then you outsource property management and you end up dealing with another unique set of experiences. Like, where is my money actually going, and how am I being charged for this? And is this really, you sort of build in some fluff, I guess, into your pro forma, because you know that if you were in control and doing it yourself, you could probably have tighter controls and save some money, but you're going to sacrifice your time. And that may not be the best use of your time. So it limits your ability to scale. So there's all these little decisions that come up in running a business that you kind of get sort of tired of, right? And you can either hire these things out or you can pivot and get into something else. But I just sort of looked at it like, again, a diversification play, getting into LP investing. But I think the panacea is, I'm in my mid 40s. When I get to be in my mid 50s, I'd like to start enjoying life a little bit more. I'll have more time, hopefully. And I eventually want to get to a position where I can have my entire portfolio shift to passive investing.
Yeah.
And, I think there's probably better returns, almost certainly, if you're an active investor and you actually handle the project and you're the one operating it. There's that upside that you really can't get as an LP. As an LP, if you're kind of swinging down the fairway, you're probably going to be in that 1.7 to 2.3 equity multiple range. And there's really no sense in trying to swing for the fences. If you can 2x your money every 5 to 6 years, that's a pretty good return. You could do better as an active investor, but there's a lot of work, stress, maybe more risk involved there. So to me, I just looked at it as sort of a transition into retirement, and why not get started now and kind of benefit from the advantages that sponsors that do different things than I do or in different markets that I'm not in have, and ride on their coattails. So
it kind of reminds me of Stephen Covey's one of his habits of highly successful people, which is starting with the end in mind. You talked about being in your 40s, and I'm in my 50s. I'd like to have more and more freedom, right? And it's kind of this dichotomy. You're absolutely spot on. Returns and control is going to be likely higher if you're doing your own real estate deals, but it should be, because it's taking more of your time to actually allocate towards that, right? And so there's kind of trade-offs on that front, which makes, I think, a lot of sense. Okay, so let's kind of take a little bit of a shift to building this balanced portfolio. It's a kind of a conversation that I have quite often with investors and folks, is trying to figure out what this looks like, right? So let's start with maybe some of the trends that you're seeing across the markets that you're involved in right now that are kind of shaping how you allocate capital, because you have been on the active side, you've been on the passive side, you've been on the equity side and on the debt side. So how do you make those decisions, and what trends are you seeing right now, Paul?
Super difficult answer or question to answer concisely. I'd say, if you're building a portfolio that's diversified in passive investments, you have to have a longer term horizon, because there's high minimum investments, usually 25,000 or more. And you've got to look at like a 10-year horizon and say, what do I want my portfolio to look like? How much cash flow do I want? How much do I want to allocate to, let's say, cash flowing investments versus development deals? Where do I want to be positioned in the capital stack where I can generate that cash flow? Debt is a great place to be if you want current pay income. If you're not as concerned about that and you want tax benefits and upside, You may want to look at getting into physical assets, multifamily.
Yeah.
You can get into subcategories of residential, like build to rent. So there's all these shiny objects out there, right? And you don't want to chase fads necessarily. You kind of want to get ahead of demand and just be, I guess, a student of the game, but look at your portfolio holistically and see where there are gaps. And kind of, I guess, to answer your question, think about how you would structure a portfolio if you were creating one of traditional stocks and bonds. Let's take the 60-40 portfolio that's very popularized, right? You've got 60% of your overall portfolio in stocks and 40% in bonds. Bonds are there to reduce volatility, create income. Stocks are there for growth and to, drive hopefully higher returns. So when I look at that type of portfolio, and I'm still invested in traditional markets, it's very volatile. And bonds have not been an attractive investment for quite some time. So really you're just looking at stocks. So I'm thinking, how can I replace bonds in my portfolio to create a little less volatility from stocks? And how can I create that income? And then I take all the different asset classes out there and I look at like kind of multifamily as the core asset. Okay. Everybody needs a place to live. It's cliche, but it's kind of true.
Yeah.
As population grows, you want to stay in front of that demand and kind of be in markets where there is population growth, or maybe there's not population growth, but there's limited supply. And you kind of create a portfolio around multifamily. And then you look for other asset classes, maybe to speak to what you asked about, trends that are sort of maybe emerging or, interesting pockets of the market where there's opportunities. Like industrial flex, for example, is one of those that I think you and I have talked about in the past, Logan, where it's
Yeah.
like there's so much demand from lessees, people that are looking for a small office space and then maybe like a area in the back where they can store their overhead. Maybe it's a franchisee owner, something like that. I know in my market, just from having conversations with brokers and other people in the space, that there's so much demand from lessees for that type of product, and there's no space available. So to
Right.
me, that means when there's a supply and demand, it always goes back to that. It's like economics 101. If I can find imbalances there and create opportunities, I can stay ahead of demand as far as investments are concerned. I can create outsized returns. So that's one of the pockets as far as interesting asset classes that I'm looking at. But we could go down rabbit holes here left and right. I don't know if I'm really answering your question, but I think it's subjective, but it's always looking at how can I be well diversified, where if one or two investments don't go as planned, the rest of the portfolio can absorb that and still keep me afloat and pick me up.
A couple of things came to mind as I was listening to that great answer, which was, Ray Dalio talking a lot about the holy grail of investing being diversification, right? Uncorrelated income streams that you're trying to put together. I can see in my mind the YouTube video with him and his white paper behind him, or his whiteboard, mapping out how he creates this holy grail of investing. And I think that is fantastic to think about. And there's actually a question that just came in that I'm going to ask you on here one second. But the other point that came to mind was, it sounded like when you started talking about supply and demand and finding the intersection or imbalance of those, a little bit of Sam Zell in there potentially, because that was his MO, right? Was trying to figure out when those lines intersect, right? You start to find those imbalances, and that's where real big opportunities are, right? And he was called the grave digger for a reason, but he didn't have necessarily the technology and the data that we have. It was him being on the ground, seeing what was going on in those markets and talking to the people that were actually executing on those deals. So fantastic response on that front. This is a great question, kind of on the same vein that we've been talking about, but is like, walk us through your kind of diversification guidelines. Is it, does it start with deal types? Is it geographies? Is it capital stacks? Like, which one should somebody start with if they're trying to figure out, diversification on their portfolio? Do you have like a this first, then that kind of scenario?
If this question relates to just getting into passive investing as a limited partner early on, some of the easiest deals to digest, I think, are debt funds. Because they do pay income, and you start to see that income hit your bank account within the first month, quarter, however they pay out. Those opportunities are oftentimes redeemable. Sometimes they have lockup periods where you can't access your capital for, let's say, a year. If you do, you might get penalized. Maybe you can't get it at all for a year, but after that year, you can redeem it. So you can kind of get a flavor for what getting involved in a syndication as a limited partner is all about. And I think that cash flow kind of is meaningful too. So I right now, with where we are in the market cycle and how I feel like there's sort of few opportunities out there that are really attractive to deploy common equity into, I think that's a great place to start, is just building around cash flow, and debt funds are a good solution to that. Then you look at existing assets that are producing cash flow, like let's say take a multifamily deal, for example, that might pay 5 or 6% cash on cash. That would be another type of asset class to consider. There's other like triple net lease, single tenant industrial type deals that'll pay you a little bit more than that may have a different risk profile. So to answer the listener's question, I think it really is individual specific as far as what your goals are. Some people would disagree with me entirely. Like, I'm a cash flow investor. I don't invest that often in ground up development, where I know other passive investors really only invest in development. They don't care about cash flow. Maybe they have a W-2 income that's really high and they don't care for, other additional sources of income that are coming in to supplement that income. They want that big outsized return. So they're focused on appreciation versus cash flow, and they're going to look for and target development deals. So it's really individually specific. And I don't know if I have necessarily a great like framework, like here's how you should build a portfolio. I think you should look at, and you mentioned this earlier, Logan, look at your goal with the end in mind, and then kind of reverse engineer it into, how can I get there? Like, let's say you make $100,000 a year for your income. If your goal is to get out of that job and replace that income, how can you most effectively and efficiently get there with your lifestyle and with the portfolio that you currently have? How do you transition it into a portfolio of limited partner positions that can achieve that goal?
Yeah, it's really well said. I'm trying to pick for the next question. We haven't got through any of all of the content today, but I'm just going to ask you this question because I think it's timely, and I want to make sure the listeners are taken care of. But with interest rates and inflation concerns, should passive investors shift their focus to, let's just say, industrial or retail or even multifamily? So it seems like this question is around, should we shift our focus to from common equity to fixed income commercial real estate holdings? So I think it's kind of what we were talking about, like what with inflation rates and interest rates where they're at and concerns on that front, is the debt side or fixed income side maybe a little bit better place to be at right now? And let's just assume, Paul, that this person has a balanced portfolio and it's not their first investment, but they are looking to make another investment. So I'll give you a little bit more context with it.
Okay. I think, investing lower in the capital stack a couple years ago was really, really prudent. I still think it makes sense in a lot of cases to invest in debt. That's what I'm referring to when I say moving low in the capital stack, being first as far as priority of payment and getting a fixed rate of return, not having that upside. I think over the last couple of years, a lot of people have latched onto that thesis and are now jumping into the party, and you're seeing a ton of debt funds out there. So I would be really careful about how you evaluate these debt funds and not jump in on the first one you see. I think a lot of times passive investors make the mistake of thinking that this space is relatively small and there's some sort of generational opportunity that's hitting their inbox and they have to jump on it very quickly. That's not the case. I made that mistake when I started investing passively back in 2016, just jumping on the first deals that I saw. This space is vast. It's huge. My inbox today gets just slammed with different opportunities, and I have to create a filter that quickly goes through this stuff so I can say no right away. I'm always looking for a reason to say no. So now that there's all these debt funds that have come to market that are newer, I really want to understand the underwriting process. I want to understand the background of the principals that are operating these debt funds. I want to understand their ability to manage a portfolio that may have some foreclosures and how they're going to handle those situations. I want to see a loan tape. I want to see what they have on their books today and does it meet their underlying guidelines that they've set out. in their offering documents.
Yeah.
Oftentimes they don't match. I don't know if that's a surprise or not for people, but oftentimes there's a disparity between what they advertise as their LTV max, let's say, for example, versus what you see on their loan tape. So I'd want to see that. And then I'd also want to see audited financials. I want to know that this firm has been looked at by the likes of Ernst & Young, Deloitte & Touche, and they can validate that what they have on their books is actually there. So all those things are things that I think the passive investors should be looking at when they get into debt funds. Now, does that mean you should only be investing in debt funds? No, I don't think so. I think there are opportunities to deploy common equity where it does make sense. And we could talk about specific asset classes. My bread and butter is really multifamily, so that's where I could dig the deepest.
Yeah.
But I'm invested in passive deals across the spectrum of asset classes. So, I think it was difficult in 2022 to make sense of a lot of these deals when you've got inflation running at like 9%, the federal funds rate's at 0, interest rates are, in the 3s, and people are taking out floating rate debt when Jerome Powell was telegraphing at the time that rates were going to be going up. That to me was kind of insane. So to deploy common equity into deals at that time where interest rates looked set to rise as they did, that typically correlates to cap rates. When interest rates go up, cap rates typically, maybe not 1-to-1, but they're closely correlated. So if cap rates expand, property values go down. So if you had gotten into deals at that time, they're probably not performing that well as a passive investor in common equity. But today, I think the dust has settled a little bit. There's not all the green lights flashing, go, go, go. It's more like there's yellow lights. There's some indicators that are really strong, and then there's some watch outs. But I think if you go into investments with a longer term horizon, maybe it's 5 to 7 years instead of 3 to 5, with a little bit more of a conservative expectation on what your returns are going to be. Maybe instead of an 18 or 20 plus IRR, it's more like a 15 IRR. And you get into deals where there's potential for multiple exit plans, where the sponsor isn't relying on one outcome built around, one pro forma. I think you've got multiple safeguards there where your principal will stay intact with the opportunity for upside. So what that means is that you should be thinking about preservation of principal first and then returns. And we're talking about deals, Logan. We're not talking about the sponsor. I think when you talk about investing passively, you always have to evaluate the sponsor, their track record, their capability of executing the plan first, beyond anything about the deal. When you get into the deal, you look at preservation of principal first, and then you consider the returns and how feasible they are.
Well, that was an awesome response. So much to kind of think about that in that. And it kind of goes back to a question that came in while you were talking was, how do you assess a sponsor? What are the crucial vetting steps? You sort of talked through that on the debt side. And I think that we can kind of call that answered for now on that front. Because it was like it was just a master class. You're talking about a loan tape, LTVs. Does the mandate that they have laid out in their offering memorandum and/or their materials and their legal materials, does it actually meet and match what is on their books? Those are all fundamental, things that you need to review. But if you had to kind of double click on that just for a second, Paul, is there anything else that you want to add to the crucial vetting steps for LPs? And I know that that's a whole episode in and of itself, but you gave us a little bit of a masterclass, but did you want to add anything to that if somebody's trying to vet out who they should invest with?
As it relates to the sponsor specifically?
Yeah.
So first of all, I would say, if you're denied access to any of the aforementioned information, and where we're talking about debt funds, but it applies to multifamily or any other asset class, hey, can I look at the underwriting file? No, we can't give that to you. It's proprietary. I call BS on that. That's a red flag to me. I don't think that there's any reason to go further into the deal. There's plenty of other opportunities where sponsors will give you a look at that, and it makes me wonder what's being hidden. So to me, that's critical. Transparency is number one. I think when you consider getting involved with a sponsor, you really have to look at it as a longer term relationship, right? It's not a liquid asset in a lot of cases. If it's not a debt fund, if it's an equity deal, you're going to be in the deal with them for 5, 7, 10 years. So how do they communicate? That's one question I'd want to know about. I'd want to look at some past investor updates that they've sent out. I'd want to talk to a couple of investors that are invested with them. Passive Pockets is a great community to tap into for that type of networking, to find other investors who've invested with sponsors that you're considering getting involved in. I actually wrote an article that's on the website there. That's 50 questions to ask a sponsor, and it's related to their team, their track record, their general approach to risk, et cetera, et cetera. And when you're on a 30-minute introductory call, maybe you get an hour at the most, you're not going to get a chance to ask them 50 questions. So you have to kind of pick out what's most important to you. But if you write them an email and you ask them a couple questions, how fast do they get back to you? Are you a priority, right? If they're not good at communicating on the front end, that doesn't mean they're probably not going to be good communicators during the hold period of the deal. So if it doesn't meet your expectations there, that's a warning sign, and one that you should take, seriously, and say, hey, this is just not worth pursuing longer. I would look seriously at their track record. Let's see some examples of successes. What's been a challenging deal? How have they learned from that challenging deal? How did they overcome it? Have they had capital calls? Have they lost any assets to foreclosure? What are other investors saying about them? I think that is so critical. And then, look through the offering docs as well. Look through the operating agreement, look through the PPM, read those risks, and read how the operation is going to be run. And if there's disagreements, how are they going to be handled? And ask all these difficult questions, see how they respond. Those are all great places to start as far as vetting a sponsor and finding out if there's somebody that you want to invest in. Well
put, my friend. Spoken from somebody who's invested in over 40 different passive investing deals. Somebody's on, I'm not sure, there's a anonymous LinkedIn user, but given, and maybe they just want to make sure that we don't call them out here, but it's a good question. It's a hard one to answer, Paul, but I'm going to give it to you. Given the U.S. debt structure, central banks reducing treasury holdings, driving up 10-year bonds, are interest rates really heading down long term? Let's prognosticate a little bit on interest rates and the future, because we love pulling out the crystal ball and telling everybody exactly what is going to be happening, because there's so many people great at that, right?
Yeah, I wish I could just satisfy this question by saying I have no clue. Anybody who
that could be the answer. That could be the answer. We can move on. But let's hear a couple. Let's at least hear your thought process on what you're tracking, because I'm guessing this person is, asking because they're either following you or I, and they enjoy the content and we're writing about it and talking about it. So what's your thought process around interest rates right now?
Sure. Well, when I look at the 10-year, I look at the risk premium. Okay. So I want to know, essentially, the 10-year is your risk-free rate of return, right? I feel as though if I put my money into a 10-year treasury bond, the U.S. government has never defaulted on its debt. Now, we could have a conversation about that as to whether or not that eventually may not be true anymore. But as it stands today, it's never happened. So I consider that the risk-free rate of return. I want to know that if I am getting into a deal, that cap rate on that deal is, with a reasonable amount of safety above that 10-year rate of return. That's the spread. That's the risk premium. That's what I'm willing to accept as an investor, that says, okay, I know that this multifamily deal is riskier than that 10-year bond. I need to be compensated for it, right? So I'm always kind of thinking in terms of that. And I put that as a backdrop to the general conversation here on interest rates. I don't know what interest rates are going to do. Cap rates have obviously expanded along with interest rates going up over the last few years. I know that the U.S. is spending roughly, I think, 5% of its GDP on interest expense, which is probably not sustainable. It's significantly more than any other country around the world. We have a high debt burden. We spend too much. We don't bring in enough.
Yeah.
That's not a good growth story long term. So we've got to kind of fix that. The economy is showing, resiliency over the last couple of years. It's been somewhat surprising. And there will be a recession at some point. When will it be? Don't know. But it looks as if there's a little bit less good news coming out from jobs reports as far as growth and new jobs being created. It looks like credit card debt and delinquency is creeping up. These are all just data points that, could be interpreted in a number of different ways, but speak to the potential for a recession coming here in maybe a little bit shorter order than it has. Obviously, we're getting closer and closer to it every day that goes on, whenever it happens. I think the Trump administration would obviously like to see rates lower. Jerome Powell's term is coming up at the end of the year. I think January of 26, somewhere around that time frame, he'll be replaced, it looks like, with almost certainty. And I'm assuming that he'll be replaced with somebody that has a policy that is similar to the administration's, goals, essentially. So I guess with all those hints and those clues and other countries around the world lowering the federal funds rate, that doesn't necessarily mean borrowing rates will fall, but oftentimes these things are correlated somewhat. So interest rates look as though they could be set to come down, borrowing rates, over the coming couple of years. So if you're holding assets that are cash flowing with debt in the 5 to 7% range, let's call it, and interest rates do fall, you're going to be pretty happy that you bought those assets, in 24, 25. But this is all crystal ball stuff. Now, I think you want to stress test deals and see, what does a refi look like at the end of the hold period if rates are higher, and assuming that the pro forma meets expectations and NOI is what it is, let's say in 5 years, how would that deal look instead of an exit if it had to be refied at an interest rate that's higher than today? And you kind of want to test the model. That's what I do as a passive investor and as an active investor as well, is I just take the spreadsheet to the edge until it breaks. Let's put in an exit cap rate that is 7.5 instead of 5.5 and see what happens to the model. And then I kind of back off those assumptions and say, well, how realistic is this? Like, what scenario would have to unfold from a macro standpoint for this to become a reality? And if it's a relatively low chance that that's likely to occur and there are multiple exit plans or strategies, I'm pretty comfortable with the deal. If it's the opposite, where everything has to go right, there's no alternative plan, and it doesn't take much for the deal to get sidebarred and sidetracked, then that's not a good deal. That's not a safe way to get into an investment as far as preservation of principles. So long-winded answer again. I know I'm good at that, but not really good at predicting interest rates. So we'll see what happens.
Well, we found out who it was, Mark McDonald. So thank you, Mark, for the comment. And he also commented here and just said, appreciate you discussing this. After all, we need to think about 5, 7, 10-year exits. So appreciate that, Mark. If you haven't checked out Paul and I's episode on his show, The Passive Pockets, go check that out. It gives you a framework, at least some way, a process to be thinking about not just interest rates, but the longer term real estate and economic business cycle. And you can make some informed decisions based off of that as well. Hey, Paul, the Burns and Commercial Real Estate Daily Fear and Greed Index just came out, right? So I have a CRE Daily hat. I don't know why I got one in mail, but I wear it all of the time. I'm a big fan of CRE Daily. Maybe the founders will come on at some point and check out the podcast or have me on theirs if they even have one. I'm not necessarily sure, but they got 530 investor responses, and the index ticked up, right, to 56, which is a sign of modest expansion. So it's just above kind of the balance zone. Like, this was really two interesting stats here. The first one being 71% of investors are in wait and see mode. And that's the highest level in the survey's history. Well, I think that is because of elevated interest rates and policy uncertainty. But there is optimism, right? 66% plan to deploy more capital in 6 months, right? So to me, when I read that, I was sort of confused. Like, okay, so 71% of investors are in wait and see mode, but 66% of those same people are planning to deploy more capital in the next 6 months. So what are we going to see in the next 6 months that allows people to feel comfortable to move forward, Paul? And where are you at in that spectrum? Did you take the survey?
I didn't take the survey. I saw the headline. I haven't read through it yet. That is interesting data. I was on the sidelines I can't speak for what everybody else is thinking. I have no idea. I think from 22 to 25, I was pretty dormant as far as I made some acquisitions. We found some pockets to allocate capital to. Got into some debt funds. We bought some smaller multifamily deals, but widely, I would say I was sidelined just because there was so much uncertainty. Interest rates were rising, was kind of waiting to see where things would go with the stress and whatnot. I think today there are some yellow lights. I think I used that term earlier in the conversation, where it's like it's not green light time. Everybody's a go. There's sort of a herd mentality in the space where once capital starts to flood in, it's a free for all, and it becomes difficult to find great deals because it seems like every deal is a good deal, and it's probably not in hindsight. So I think today there's less competition. So that's one pro, is that you can get in and look at deals and feel as though, and I'm talking from the active perspective, or from a passive perspective, getting involved with operators who have that unfair advantage in their market and have relationships with brokers and are getting first look. I think those that are in the market today, that are patient and have that longer term view, are going to be rewarded. I think you can hit singles and doubles and have limited downside on some deals. So I'm kind of a buyer in this market, but I think you have to be selective on what pockets of the market you're looking at. If you're looking at and I'm just going to hone in on multifamily again, if you're looking at that 1980s vintage, value add deal that's got 60% of units renovated, and there's another 40%, there's upside from rent growth through renovations, and you've got to add capex, and you're counting on this rent growth that may or may not be there, and your expense load is growing lower than your pro forma rents are, and there's all these things that worked, I guess, pre 2021 that just don't work today. I don't think there's a lot of capital that's flooding into the space for those types of value add multifamily deals. I think a lot of LPs were burned by deals that they were in that had floating rate debt that were bought at the peak, and they've kind of backed off of those. So that's not a pocket of multifamily that I think is really attractive today. I think there is some newer vintage product. I just sold an asset and ended up coming in as a tenant and common investor through a 1031. We raised some money through our fund for the same deal and partnered with another operator locally on an asset that was built in 2023. And it was delivered in 2022 in a market that had a lot of supply. Yep. So the merchant builder was not a property manager, but they tried to manage it on their own. They did so dysfunctionally and made some mistakes. They had trouble with lease up. Some of that supply in the marketplace has been absorbed and sort of resolved itself. Some of the concessions that this developer offered tenants have started to burn off. And we acquired this asset at a basis that's well below replacement costs. It's a beautiful asset that doesn't need a lot of capital improvements at all because it's so new. So we eliminate the risk of tariffs on a deal like that and what that could do to input costs on like a capital budget. Yeah. We eliminate a lot of the declining infrastructure within an older building that could end up popping up as a surprise. And we get cash flow day one on an asset like that. If interest rates do drop in say 4 or 5 years, we're going to be very, very happy that we bought that. If they don't drop, we've got a little bit of rent growth that we can build into the pro forma. And there's nothing coming out of the ground in this market because it's so difficult to build today that in 26 and 27, there's going to be an undersupplied market instead of an oversupplied market like this developer delivered that product into. And we're going to have a lot more pricing power control on rents and potentially be able to grow that rent roll and grow that NOI. So I think those type of assets are really interesting. That's a corner of the market that we're attracted to. And then there's like oddball stuff, like like tax abatement deals, LIHTC, heavy value add type deals if you can find them, where you do a gut renovation and there's a lot of yield on cost, meaning that your total project cost divided by your stabilized NOI divided by your total project cost is well above the market cap rate. So you're creating a ton of value there once you're done with your plan. Those are interesting deals. Sometimes like hotel conversions are interesting deals. So there's like corners of the multifamily market that are kind of interesting, but broadly speaking, that sort of pre-2000 type product that is the traditional value add that maybe has been passed around as like a first, second, third generation value add is just not there today. There needs to be some additional cap rate expansion, I think, in that space, and some price discovery needs to occur where the bid and the ask come together a little bit more, and it makes more sense for buyers. There's going to be a time where it does make sense again, right? Where the pricing is in line and there is value to be driven and there is upside. I just don't think it's today yet. So.
Yeah. Really good response there. There are always pockets to find, and you have to be in the market, talking to people, understanding, evaluating deals and different market trends. Because so on that note, I appreciate the comments and questions that we're getting in from LinkedIn and from YouTube. So thank you for all of that. Yes, we're going to talk about markets now. So got a bunch of questions around. Okay, so you didn't give us a framework necessarily to think about geographic first, asset type, and capital stack placement. We kind of have an overarching approach to that, but let's try to figure out, where is Paul Shannon investing? How are you looking at markets, and what are you, shaking out in regards to some of your favorite markets that you're evaluating right now?
Sure. Well, from an active perspective, as I mentioned, I feel like staying hyper-focused locally is where I have an advantage. So I'm only investing in Indiana because that's what I know like the back of my hand. I know street by street in a couple different metros. I have relationships here. I know who to call if there's issues. I know who to call to get information that I don't have. So those all lead to somewhat of an unfair advantage and confidence, frankly, that I'm making the right choice, particularly if it's a significant sum of my own money or investor capital. Now, if I'm investing as an LP, it's a completely different scenario, right? Because I want diversification away from this geography. I've got plenty of exposure to Indiana. Now, I think other Midwest cities have similar characteristics, so I don't typically invest as an LP in deals in the Midwest. Although I do like the Midwest overall, because there hasn't been that major development boom where there's been this influx of supply. There hasn't been that huge run up in rents followed by that big decline where now there's, flat to negative rent growth. It's been a pretty tight market. Occupancy has been high and rent growth has been higher than the national average over the last couple of years. The Midwest markets, Louisville, Indianapolis, Kansas City, some of these are the best performing markets in the country from a rent growth standpoint, which is kind of backwards from a historical perspective as far as the Midwest is concerned. So I think there's really, really good opportunities in the Midwest for investors to get in and hit those kind of singles and doubles, particularly on like the newer vintage stuff that maybe you can get at a discount to replacement cost, like we talked about before, et cetera. So other than that, I'm trying to stay ahead of demand. I think that I like to be in landlord friendly states. So, I know that there's operators that have expertise in coastal markets. Let's pick on California, for example. High taxes, difficult municipalities to deal with. It's hard to get a tenant that's not paying out of their units. There's all these different challenges that we just don't face in the Midwest.
Yeah.
I'm sure there's operators that are very, very uniquely positioned to capitalize in those markets. But I just don't have, that expertise, that network, and that, most of the people that I connect with are investing in tenant or landlord friendly states. So that's where most of my investments tend to be. And I think that I spoke to Greg Willett, the economist, a couple months ago, and he gave me some statistics that I wasn't aware of. This year, there's going to be 400,000 units delivered, multifamily units delivered, which is still pretty high. Not as much that was delivered in 23, but about half of those units are being delivered in 15 markets. And to be fair, those 15 markets have probably seen, their populations grow to support those developments, although there has been some oversupply. I think now it's gotten very, very difficult to build in some of these Sunbelt markets, for example. So in 27, 28, I think we're going to see that there's supply constrained markets again. So, and I think that the job growth story in those areas is still strong. I think the migration, just the desire for people to live in warmer climates, me being from the Northeast and moving to the Midwest. I've never figured out a way to get to a warm place, but I can certainly see the appeal. So I think a lot of people think that, hey, I'd love to live down in North Carolina or Florida, or businesses are moving to Texas because the climate there, the business regulations, the laws are very friendly. So I think that population shift will continue to happen to those markets: Texas, Florida, Georgia, Tennessee, North Carolina, South Carolina. So those are places that I'm interested in partnering with really sound, solid operators who have a strong track record, have unique deals that have a story behind them that kind of fit the mold of what we talked about before.
Absolutely, man. Really well said. We all know I don't really need to talk much about Kansas City. I talk about it all of the time. But we had another listener kind of type in on a comment on LinkedIn, hey, our development costs improving, architectural buildings are dropping significantly, and that tends to follow architecture designs, 12 to 18 months backlogs on the construction side. So, of course, this may not be offset by tariff impacts on materials. I think what we are seeing, at least I'll kind of talk to this a little bit, is, we had, and you mentioned this, Paul, in 2024 was the largest amount of multifamily units delivered, I think, in, I don't know, maybe
the 70s, I believe it was.
Yeah, 70s. So, I mean, it was a lot. I think the baseline is somewhere between 330 to 400,000 units, right, on average. But we all know what has kind of has happened in that regard. The starts, I mean, these deals, they take 12, 24, 36, 48 months to get started and then actually be delivered. So, we always have this kind of lag on the multifamily commercial real estate starts. And most, I would say a lot of the different markets in the Midwest, which is why rent growth has been so high, is they just weren't targeted to be developed, right? You don't have those large institutional players being able to deliver thousands of units in one of those Midwest markets. Now, we're starting to see that kind of catch up, right? But then you throw in tariffs and the policy uncertainty, and who knows kind of where that's going to be, right? So, but the point that I want to make is, in between all of those supply imbalances, the supply and demand imbalance creates opportunities within that. And Paul gave us a great example of how he was able to capitalize on when a merchant developer came in, delivered the product type. Nothing against them, right? I mean, they just delivered when a lot of other people were delivering and the units were there. Lease up is hard. They're not operational experts. Boom, there's an opportunity to step in on a almost brand new spanking multifamily asset. So that's a prime example of how, even within the market timing that we're in currently, how opportunities are going to be found, even though maybe the overarching larger themes would say, hey, this might be a time that is hard to invest. When you find those little pockets, it's really exciting because it can mean big rewards for investors that have capital, they have courage, and they have a long-term perspective. So I just try to bring all that together and tie that together. Paul, any thoughts on that before we move on?
No, I think you covered it, man. That was well said. There's always opportunities. I think in every market, in any part of the market cycle, it's having access to deal flow, relationships. So, just like you and I met through networking, I think that is one of the most critical skill sets that anybody should develop, whether they're an active investor or a passive investor. I tried to go in it alone. I know when I got into this space, I was, I was a lone wolf, so to speak, and It hurt me. It set me back. I should have been networking far sooner. And that goes for LP positions too. I got involved in a couple of deals that were average. One that I should have vetted more, and it was a learning opportunity for me to know that I should have leaned on my network or at least had a better network and tapped into it to know what I don't know and ask questions and find out from others who've been there. So I think, the more conversations you have, the more tied in you are to the market, what's happening on the day to day, but the more opportunities you'll be exposed to. And you'll start to, as I've developed in this space, what I've found is that you can have sort of a general framework for where you want to be in 5 to 10 years, but you really have to focus in on the process, right? It's somewhat cliche. You have to fall in love with the process. And part of the process is just having a ton of conversations, and you never know where those conversations are going to lead. And usually, you're directionally correct, but how you get there is where you get surprised sometimes, and it all happens through conversations.
Most definitely. Well, we're not even going to scratch the surface here today. Sorry, we've got, I don't know, probably 10 or 12 questions. Here's what I would say. Go over to LinkedIn, find Paul on LinkedIn. But Paul, tell us a little bit about InvestWise Collective, because I'm looking at messages here from in questions. It says, hey, I've got capital I'm trying to allocate. Where can I find out more information? Let the people know, because we didn't get to all the questions. We'll have to have you back on for sure to discuss that. Maybe we'll just have a Q&A session, and I won't steal the show away from all of the listeners, but very popular, audience here. So got a lot of questions. They want to connect with you. Tell us a little bit about InvestWise Collective.
Yeah, I appreciate the opportunity, Logan. Thank you. InvestWise Collective was born in 2023 out of frustration more than anything. I think we, we're banging our heads against the wall. I mentioned we underwrote so many deals on the multifamily side, and just we're coming up blank. 80 to 85% of guidance from brokers, those LOIs weren't getting looked at. So we were frustrated. We were underwriting to fixed rate debt before it was cool, when everybody was, still acquiring with bridge debt. So we weren't able to get as much leverage. If you can get more leverage, you can pay more. So that's what we were losing out to. And we just thought, man, if we keep doing the same thing we've been doing over and over again and expect a different result, that's sort of the definition of insanity, right? So we've got to kind of pivot here and change directions. And while we were going through that frustration, I and a couple other folks that ended up being my partners in InvestWise Collective were allocating as LPs into deals around the country and different asset classes. We were finding yield by broadening our investment focus, if you will, or just, our geography, our sponsor network. We were looking much farther outside of just Indiana multifamily, and we were finding those deals. And we thought, hey, if we can provide one of two value propositions to investors, we think we have a business here. One was access. If we can give other investors access to deals that they otherwise wouldn't be able to get involved in because of high minimum investments, we have a value proposition for a business here. And it also allows us to get into deals. We're invested in a debt fund that has $1 million minimum investment. That's not a check I'm writing. I know that, but I'd like to get in. And after vetting them and understanding the business plan, it's a really good deal. We've been invested with these guys for 2 years now and had great results, and it's currently open for investment. That is a strong value proposition to allow access for as little as $50,000. The other value proposition is negotiating better terms. It's gotten more difficult for sponsors to raise capital over the last couple of years. A lot of deals haven't gone as planned, and that's left a sentiment issue for a lot of limited partners. So it's costly. There's overhead involved to employ a investor relations team, capital raisers internally. You think about a syndication business. If you can, instead of calling 300 investors to get, 50 checks for $50,000, deploy your resources and employ a company like ours to go out and handle that capital raising for you, that's great for the sponsor. So we're solving one of their problems by reducing their overhead, cutting their capital acquisition costs, and providing a big check into their deals and helping them acquire these assets. For the limited partner, we can leverage that larger check size and negotiate better terms with the sponsor that then we can pass on to our investors so they can get better terms than they might if they invested directly with the sponsor. So there's a value proposition for the LP there as well. Assuming that we can make our fund economics work. We're always, as partners of InvestWise Collective, investing as individuals into our fund with the same terms as our limited partners get. And there's 4 of us. We all have to agree on these deals that we get involved in, but we always it's different than some funds where a blind pool fund, you'll basically wire your funds. You'll buy into the thesis, the buy box, whatever it is that the sponsor is pitching, and you'll wire them the funds, and then they have that in their bank account and they can go out and spend it. You don't actually get to underwrite the individual assets. What we allow our investors to do, because we are asset agnostic, we're capital stack position agnostic, we allow them to determine whether or not they want to be involved in the deal. It's kind of like an a la carte menu where they get to pick what deals within our fund they want to participate in. They can say no. So we give them kind of first right of refusal, but we always invest, as a team into these deals together. We just think that's the way to do it, because not everybody has the same investment goals. Again, let's take an example. I'm a cash flow investor, and let's say I'm looking at InvestWise Collective, and InvestWise Collective presents a development deal. That may not be for me, right? Because there's no cash flow probably for 3 years. Maybe there's never going to be cash flow. It's just the upside at sale. So I can say as an individual investor, that's not the deal that I'm going to participate in with InvestWise. So we like to give investors the option to kind of create their own portfolio, but we try to spell out all the risks as we see them. We're not registered investment advisors. We don't make recommendations. We say, this is why we're investing personally, our own capital. This is what our concerns are. This is why we really like the deal. And then we let the investor decide.
Excellent. If you want to learn more, I just dropped the links down on YouTube and on LinkedIn, investwisecollective.com. Make sure to go follow Paul on LinkedIn. He's always dropping great information, most up-to-date trends. I love his posts. I watch them. I read them on a regular basis. Paul, thank you so much for joining us today, man. You're just a wealth of knowledge. So many people are excited to kind of get their journeys going, and they can learn so much from you. But outside of InvestWise Collective and LinkedIn, should they be connecting with you anywhere else?
Yeah, check Passive Pockets out, particularly if you're a passive investor. It's a great community of limited partners, like-minded people. Even if you're a sponsor, you can get into the community. There's forums that you can discuss opportunities. You can kind of vet individual deals. You can talk about complex tax situations. You can lean on people who have been there and done that. And I think that's really powerful. And there's also a lot of educational materials on there. So I would check out passivepockets.com.
Yep. Just drop that into the comments as well. Paul, appreciate it. I know you're a busy guy. Thank you not only for having me on your show, but thanks for coming and sharing your journey and all of the knowledge that you dropped today. Really appreciate you and everything that you're doing for the industry, the transparency, and the ability to bring these insights to the audience. Obviously, with the questions that we didn't get to and the ones that we did get to, it was very popular. I'm sure it's going to be watched a ton. So thanks for your time, Paul.
Thank you, Logan. I really appreciate the opportunity. I've enjoyed it.
All right, guys. Well, we will see you in a week or 2 weeks. Not exactly sure when the next show is going to come out. I show up and I come in and try to bring you guys awesome guests like Paul, but I'm sure we're going to have another episode coming out soon. So thanks for tuning in to the Kansas City Commercial Real Estate Market Pulse, and we'll see you next time. All right, man. Nice job, brother.